Interest rates are still at record highs, homes are still appreciating year after year, and demand is still high for home buying despite both of what I just mentioned, interest rates and home values. I know there's so many people who are hoping that there's going to be a market crash, and based on everything that I'm seeing, there shouldn't be a real reason to have one, except for one thing. This one thing could set the housing market into total disarray and might actually be the thing that causes a housing market crash. But first, before we get into that, my name is Tiffany. I'm a loan officer here in Las Vegas, Nevada. I've helped over 200 families with their real estate needs and would love to help you with yours. So I'm going to leave all my contact information in the description below so you can reach out. We can see how I can help you. Things I can do include buying a home, refinancing a home, maybe taking out equity. So if you've got a home need, I can help you with it. So contact me in the information below and I'd be happy to get the process started and see what your options are to help you become more wealthy through real estate. But now let's get into the video. So despite everything that's happening in the market, there should be no real reason why a real estate market crash would happen. Home buying demand is still at record highs, but interest rates are relatively in the 6 range, probably for the next year or so. And there's still people who want to buy homes, so homes are still appreciating. So for the most part, every person who's in real estate is telling you there's no sign of a crash, because when you look at it at a surface level, there should be no reason for a crash. But here is the thing I think so many people are missing. In fact, some people are starting to catch on to it, and I'm starting to catch on to it myself. If there's one thing that's going to knock real estate into a crash, it's going to be homeowners insurance. Homeowners insurance has been often one of those things that people don't give much attention to in the home buying transaction, but is proving to be a huge player as we're seeing more natural disasters and events happening. But before we dive into why I think it's going to be the cause, let's go into homeowners insurance itself and the role it plays in a real estate transaction. Homeowners insurance is a type of property insurance that protects homeowners financially in case of damage to their home, personal belongings, or liability for accidents that happen on their property. Most mortgage lenders require homeowners to have insurance to secure a loan. That's pretty much at surface level what homeowners insurance is. But let's talk about what homeowners insurance actually covers. So when you go to ABC Insurance Company and go get a policy, what are you actually getting as a product? A standard policy typically includes dwelling coverage, so pays to repair or rebuild your home if it's damaged by covered events like fires, storms, vandalism. It could also cover other structures coverage, so things like fences, garage, sheds, ADUs, etc. Personal property coverage, so if you have any personal belongings in the house, you can actually insure those through your homeowner's insurance policy. Liability protection, so it covers any like legal or medical expenses if someone is injured on your property or if you accidentally damage someone else's property. And it can also cover loss of use, so additional living expenses. So for whatever reason you're placed out of your home, like if a fire happened or a tornado happened and insurance needs to make some repairs in order to make your home whole again, they will actually cover your expenses if you go live somewhere else or rent another place for the time being. So that's what a standard policy of homeowners insurance looks like. Most mortgage banks are going to require you to get homeowners insurance in order to close on the loan. In fact, it's a hard stop. If you can't get homeowners insurance, you can't get a loan. And it's because basically homeowners insurance ensures that the bank, whoever is lending you money, that their investment is covered. So for whatever reason in year 10 of the loan, if your roof suddenly falls apart, the bank wants to know that, hey, their investment is covered and that their investment is good for as long as they're responsible for that home. Because if you don't know, you don't actually own a home yet until you pay off the mortgage that is due on the property. The bank owns it until you pay off that mortgage, and the bank wants to make sure that you're being a good steward of that home, of that investment, until they basically are done with that property. So they want to make sure that their investment is covered in the meantime of you making payments towards owning that home. If something should happen to the home, like the roof goes out or like it gets burned down, the bank wants to make sure that their butts are covered basically, and that their investment is going to be made good on that property. I have never seen a transaction close without homeowners insurance. It's just one of those things that is usually a non-negotiable. Like if you can't get mortgage insurance, you can't get a mortgage. And for the most part, it hasn't really been an issue. Like I've never had a case where someone that was buying a home couldn't go to like State Farm, Geico, Progressive, whoever is offering their homeowners insurance, and be able to get some kind of policy. But that might be changing here soon. Over the last 10-15 years, we've seen more natural disasters occur than have ever been recorded in American history. And what's crazy is that homeowners insurance is starting to catch on to the fact that these natural disasters are happening more frequently and are causing way more havoc than they have previously. In fact, let's talk about the California fires that just recently happened in the Palisades area, which, mind you, is not the first fire to happen in California, specifically in that Los Angeles area. In fact, there have been several areas that have been affected within the last 5 years. But this Palisades fire seems to be the catalyst of insurance companies realizing the magnitude of what it's going to take to insure people in California. In fact, what's interesting, before this fire even happened, about 6 months before, thousands of Los Angeles homeowners were dropped by their insurance companies before the Palisades fire even happened. So before all of this devastation just happened, insurance companies were trying to get out of California, trying to basically get out of paying those premiums in California, because even though they were more expensive in California, in case you didn't know, California is pretty expensive, so the premiums there were already pricey. But most companies decided that it's not even worth it to lend in California. And the companies that were there are trying to basically get their tails out because they do not want to be responsible for having to cover the state if a major tragedy should strike. Which, mind you, California kind of has a perfect storm of tragedies to happen there because it's on San Andreas fault line, so that's already been a huge concern for people. It's prone to a lot of fires because of, especially if you're not close to the beach, that area tends to be pretty dry in California. So it's a perfect storm for wildfires to occur. And then you also have the natural disasters that can occur with the ocean being right there. California, even though it's seen as this idyllic and perfect place to live, has its fair share of natural disasters that could honestly scare pretty much anyone from living there, including homeowners insurance companies that have seen this as a bigger risk than is worth taking on. What's really sad about this is most people before that Palisades fire happened were on the state-issued FAIR plan, which is actually not exclusive to California. A lot of states actually have their own version of a FAIR plan, and it's basically seen as last resort insurance. It's not ideal by any means. You don't want to be on that plan because it's funded through tax dollars, and especially because if that plan is relatively new, then it probably doesn't have the reserves in there to be able to cover this level of devastation, which is exactly what Californians are seeing with this FAIR plan now. In fact, about half of homeowners were under this FAIR plan at the time of the Palisades fire, and the FAIR plan did not have enough reserves basically to cover the devastation that happened in that Palisades area. So now, not only are these people displaced out of their homes and they are now trying to find, where are they going to live? How do they restart their lives? How do they try to come up from zero now? They are now going to have to fund half of this FAIR plan to rebuild Los Angeles. It has been reported that California homeowners will have to fund half of high-risk insurers' $1 billion payout. This FAIR plan is truly last resort. It was by no means anyone's first choice, and now they're going to have to fund to rebuild Los Angeles, which is absolutely crazy. I cannot imagine having someone go through that level of devastation and having to repay to rebuild that city. But that is the situation that they're in California because so many homeowners insurance companies did not want to be involved with California because of that exposure to natural disasters that happen there. And what's even crazier is that, let's just say a homeowners insurance company did stay there. You're seeing so many increases in premiums. In fact, just this week, State Farm asked California to raise homeowners insurance premiums by 22%. And guess what? They got it. Because California is so desperate to keep insurance companies insuring California so less people rely on that FAIR plan, that they're willing to take a rate premium because they know that they would rather have some kind of insurer in California than have everyone rely on this FAIR plan that's clearly not built out the infrastructure yet for this level of devastation. So it's truly sad to see what's happening in California, and this is just the tip of the iceberg. There's so many more states that are experiencing not quite this level of devastation, but some level of devastation, and are relying on some kind of insurance company to come and pick up the slack. But those companies are starting to catch on to the fact that these areas are not very safe. In fact, you're seeing this in Florida, you're seeing this in North Carolina, you're seeing this in Louisiana, you're seeing this in Texas. In fact, I even saw a report from someone in Arizona who's concerned about their homeowners insurance premiums going up because of concerns of wildfires in Arizona. Which, speaking of insurance premiums going up in affected states as natural disasters, this is actually happening just across the board. You're seeing insurance premiums go up nationwide to justify the increases that are happening in the devastated areas from natural disasters. In fact, a report from the Intercontinental Exchange showed that the average insurance premium nationwide went up 61% over the last 5 years, and that it is continuing to go up as the years progress. What's also interesting to note here is that in addition to natural devastation that is happening, it's also because it's gotten more expensive to replace homes. In fact, a study from Laura Curtis shows that the cost of rebuilding a home is up 44% due to inflation. So if you are someone who bought a home prior to COVID and the huge, appreciation that happened in 2020, that it costs now more to replace the items in your home. Like if your home burns down, it costs way more for them to go back and rebuild that home for you, or to put you out of place, or find you somewhere to live, all of these things. So they're justifying premium rates across the board. Basically, they're saying that inflation, natural disasters, it's just really hard to be an insurance company these days. What's sad about all of this is that insurance is basically making people decide whether they can actually live in their homes or not. In fact, there is a report from Housing Wire that shows insurance worries are forcing homeowners to rethink their living arrangement. American homeowners are struggling to keep up with unpredictable natural disasters and the rising homeowners insurance premiums that follow them. Residents are more willing to move if it means avoiding high insurance rates, according to a study from mortgage technology company Maxwell. And one state stands out among the rest in terms of risk: California. In fact, in that report from the Intercontinental Exchange, it shows that annual property insurance costs for a mortgage single-family home rose by a record $276, or 14% in 2024. And that report also states that average premiums are now up 61% over the last 5 years. And this is what Janet Yellen, the former Secretary of State, had to say about it. She says, "This report identifies alarming trends of rising costs in insurance to consumers and insurers themselves, as well as a lack of availability of insurance, all of which threaten the long-term prosperity of American family." This isn't even just an issue of, hey, now you're going to have to pay a little bit more for homeowners insurance. This is truly a make or break of whether or not people can actually stay in their homes, because homeowners insurance is just rapidly increasing every year. And it's one of those things that you go into a mortgage payment thinking your payment's going to be fixed for so many years, but between property taxes going up and homeowners insurance, it's like, is your payment actually fixed anymore? Or is it going to continue to get so unaffordable to the point where you can't even live in the home that you own now? And that is a sad reality that we're heading into as insurance keeps rising. So speaking of the Palisades fire that we had just mentioned earlier, there is a report that shows that an estimated 680 homeowners fell behind on their February payments, and we're expected to see more mortgage delinquency the longer that this fire is taking to basically wrap up. Given that these fires started in January, this is what we're just seeing as of February, and I'm filming this as of March right now, so the devastation is yet to be fully seen as far as how are people going to do as far as their mortgage payments. But I think that's what a lot of people are failing to realize in this situation, is that just because your house burned down, that doesn't mean your mortgage is suddenly gone. In fact, insurance still needs to come in and basically total out that property and say it's a total goner, and then they'll pay out the insurance claim to the mortgage company, and the mortgage company will then say the debt is good. There is such a burden on these homeowners insurance companies to basically go out to all these homes and total out debt that could totally bankrupt a homeowners insurance company. So there's a lot of homeowners insurance companies right now that are being very conservative with what their numbers end up coming back at, because that could impact their ability to lend on further more policies. But the domino effect here is that if those homeowners insurance companies take a while and maybe they don't give the full value that they were supposed to, then mortgage companies are going to be at the brunt end of this, and that debt, it hasn't been satisfied. So it still falls on the homeowner in that case to make that mortgage payment until that debt has truly been satisfied. So I hate to say this, but I think that there's probably going to be an uptick in bankruptcies, foreclosures. There's going to be a greater financial devastation here than just the fact that these homes burned down. If that wasn't enough to cause devastation, homeowners insurance being conservative and maybe not doing what they need to because they're scared to go bankrupt is going to cause devastation on other levels financially. In fact, Countrywide, which is a big insurance company, as as well as larger other insurance companies, are making efforts to combat rising insurance rates. In fact, they wrote a letter to President Biden in June of 2024 urging the government to address rising homeowners insurance prices, calling for federally backed homeowners insurance. So basically they're saying, government, please help us because these homeowners insurance are not going to get any better. Very similar to what they did with like medical insurance, because they're saying that the rates have gotten too expensive that this could devastate the average homeowner. And they're not the only ones who are calling this out. In fact, the Federal Reserve Chair, Jerome Powell, actually went before the US Senate and said this exact same thing, but he took it to another level. He said, in about a decade or more down the road, homeowners in some parts of the country will not be able to find homeowners insurance. This is the direct quote. Both banks and insurance companies are pulling out of coastal areas or areas where there are a lot of fires. So what that is going to mean, if you fast forward 10 to 15 years, is there are going to be regions of the country where you cannot get a mortgage. There won't be ATMs, there won't be banks, so it will fall on homeowners and residents. But it will also fall on the state and local governments, which is what you're seeing now. That's where they're having to step in with the FAIR Plan. In states where insurance is going away, you're seeing states step in because they still want those areas to remain prosperous. So coastal areas, think of Florida, think of California, think of Louisiana. There is a lot of devastation on the line for these people if homeowners insurance ends up being something that they're no longer being able to access. So I asked my good friend ChatGPT what issues would happen to the real estate market if homeowners insurance was no longer able to be found in your area. And this is what they had to say. Number one, home values would drop. Buyers typically need insurance to secure a mortgage. If lenders can't require insurance, they may not issue loans, reducing demand and forcing sellers to lower prices. Cash buyers would still exist, but they demand steep discounts due to the increased risk of owning an uninsured property. 2, mortgage lending would stall. Most lenders require proof of homeowners insurance to approve a mortgage. If insurance isn't available, banks and other lenders may refuse to issue loans, significantly slowing down the housing market. 3, investor interest would decline. Real estate investors generally don't want to take on properties without insurance because it increases liabilities and potential losses. Fewer investors means fewer rental properties, which could tighten housing supply and drive up rental costs. 4, cash buyers and risk-tolerant investors would dominate. Those with the means to buy homes outright might still purchase, but they would expect steep discounts. Wealthier investors may be willing to take on the risk, but they'll likely factor in higher reserves for potential damage or legal liabilities. 5, foreclosures or distressed sales could rise. If homeowners can't get insurance, some lenders may call in loans, leading to foreclosures. Homeowners might be forced to sell at a loss, increasing distressed sales and lowering property values across the market. 6, local governments would face challenges. With declining property values, local tax revenue would decrease, impacting public services like schools, infrastructure, and emergency response. Areas prone to natural disasters like hurricanes, floods, or wildfires might see an exodus of residents, creating ghost neighborhoods. 7, the housing market becomes riskier and more volatile. Without insurance, homeowners are fully responsible for repairs after disasters, which could lead to financial devastation and increased abandoned properties. The real estate market would become more unpredictable, with price swings driven by investor sentiment rather than steady homeowner demand. So all of that to say is that if we can't figure out this homeowners insurance thing, expect very poor economies, expect, less police in your area, expect less infrastructure in your area, expect basically investors with the means to come and buy these houses cash to come in and dominate, lowering price values. All of this leading into the ripple effect of why I think homeowners insurance would be the nail in the coffin to cause a market crash. Now, do I think this is going to happen tomorrow? No. But I do think that areas like California, Florida, Louisiana, those are going to be really good guinea pig markets for us to study, because what happens with homeowners insurance there is going to dictate what homeowners insurance companies do nationwide. They're just going to experience it first because they're the most prone to natural disasters and devastation in their area. So if I were, someone who is concerned about the state of the economy, I would pay close attention to those markets and see, how is homeowners insurance going? Is everyone basically on the FAIR Plan? Is everyone able to get a decent homeowners insurance policy? Are people being priced out of these areas? What is the level of migration to and from these states going to look like for the next few years? And what is the percentage of homeownership in that area versus people who are renting in that area? I think those are the things that I would look for to get an idea of, hey, which way are we moving with this homeowners insurance thing? Because if this is truly a devastation level plague that we're about to run into, then people need to know that things could get very dark here very soon if homeowners insurance decides to pull that plug. But if the government decides to step in and save homes before, homeowners insurance companies pull out first, then you know that we're pretty much on a good path and that we should be able to save the housing market before any true devastation happens. So that's my final thoughts. I hope you guys enjoyed this video. Please make sure to give it a big thumbs up and subscribe if you haven't already. And if you have any questions about homeowners insurance and what I think is going to happen in the nearby future, drop them in the comments and I'll be happy to reply to as many comments as I can and give you guys more insight into what I think is going to happen with homeowners insurance, when I think the timing is going to happen, if anything will happen as far as homeowners insurance companies pulling out, and what could also be some other hidden things that lead to a market crash that people maybe just aren't paying attention to. So with that being said, I look forward to chatting with you guys in the comments, and I will see you guys next time. Bye!